Well, hello. This is Danielle DiMartino Booth with Real Vision, and today we've got a real treat. We are bringing you Christopher Cole with Artemis Capital. We've been waiting for over 2 years for a follow-up to his seminal paper. It's out there. You have to read it, share it with people. Maybe not people under 18, they wouldn't understand it, but everybody needs to get a copy of this and read it. We're going to discuss what it's all about today. Welcome.
Thank you. It's a pleasure to be here and back on Real Vision again.
So I'm going to start with an anecdote. Years ago, I was in Omaha, and I visited with Charlie Munger, and he made the comment to me that the entire pension fund advisory business one day would go out of business. It would go the way of the dodo bird because of the groupthink that surrounded the industry, because of the way that the portfolios were being designed in a world where central banks were effectively running the show. And he made the comment to me that he saw in the future, he said, I might not live to see it, but you will, the death of the efficient frontier. So I'm curious about your thoughts on portfolio construction, how it's done, and how that evolution has changed basically the way this entire generation approaches investing.
Well, beginning with that and looking at what Munger has said, as a follow-up to my last letter, the Ouroboros letter, that talked about the cycle of risk and how volatility has been used as both a proxy for risk and also as a source of return.
Right.
I thought, what will disrupt that cycle? I posed a question to myself saying, well, if we're going to see what happens in the future, we have to look to the past. And the distant past, not just the recent past, not the last 10 years, not the last 40 years. We need to look back 100, 200 years to understand the cycle of capital creation and destruction. And I posed this question to myself. I said, imagine that someone gives you generational wealth, enough money that you can live and your children's children can live at a high level. But it's subject to one question, one dynamic. You have to choose an asset allocation and stick with that allocation over 100 years. What allocation do you choose so that your children's children will have prosperity? And taking that cue, I went back and looked at 90 years of historical data, back-tested a wide range of popular financial engineering strategies. Everything from risk parity, the traditional pension portfolio, short volatility, long volatility strategies, commodity trending strategies, and looked at how do these perform and what asset allocation is the allocation that's going to provide wealth, not only consistently over 90 years, but through every generational cycle, through both periods of secular growth and secular decline. And what I found surprised me, that echoing Munger's statement, the allocation that the majority of US pension systems and retirees are following, which approximately today is about 70% equity-linked products. That could be everything from stocks to private equity, things that are that profit from secular growth, and about 20% bonds. That portfolio has done incredibly well over the last 40 years. But when you look at that portfolio over 90 years, you see a very, very different reality. And that has a wide range of social, economic, and social ramifications that become quite startling. But looking at that, I say, what asset allocation can I find that will actually provide protection over that 90 years consistently? And that answer came not from a macro view. It doesn't come from me having an opinion about whether or not we're going to go into a recession or whether or not there's going to be some continued economic prosperity. It comes simply by looking at data, using mathematics, looking at data, and looking at empirical data over a lifetime to come to that determination. And I think the results are quite shocking, and I think they run somewhat counter to the consensus knowledge as to what optimal portfolio allocation should be.
So Charlie Munger was right.
I think he's right.
take a step back to the October 2017 paper, if you will. Back then, you kind of drew the scope of the financialization of the markets, of the economy. You talked about risk parity and share buybacks and this massive effect that they had on the crowding in to certain asset classes. So talk about what effect this herding instinct has had on the way this generation views investing.
You and I have a very similar writing style because
Yes.
I love metaphors. I think visually. I think you do too.
Yours are better.
Yours are they're very good. So, but in that 2017 paper, I think I wanted to use the idea of an Ouroboros, this concept of a snake devouring its own tail. And what this was a metaphor for what is now about $3 trillion in equity markets alone. This is just equity markets, U.S. equity markets. If that number is much larger if you expand that across asset classes. But of strategies that use volatility as an input for taking risk, but also seek to generate excess yield, either through selling volatility or through the assumption of stability.
Right.
So in this number, you have implicit and explicit short volatility strategies. And I think there's a lot of confusion as to what this means. Explicit short volatility strategies are strategies that they will sell derivatives. So they'll sell options.
So the easiest would be selling the VIX.
Selling the VIX, that's right. So this paper came out prior to the XIV blow-up, and it talked about how the VIX ETPs were likely to have significant problems. But that's a very small component of that short volatility trade. A much larger component of the short vol trade are strategies that replicate the risk parameters of short volatility trades, but may not actually be shorting volatility.
Okay.
So strategies like this might be things like volatility targeting funds or some elements of risk parity, for example. It's not
risk parity is still something we don't hear a lot about, even though it's massive.
Yes, yeah. And the framework there is, this could be anything between literally shorting volatility, what I'll call short gamma, or being short trend. And we could talk a little bit more about that. Short correlations, short interest rates. These are risk factors of a portfolio of short options that various financial engineering strategies will replicate. Maybe not all of them, but certain aspects of them. That doesn't mean all these strategies are bad. It just means that they are formulated to a world where interest rates are dropping, assets are mean reverting, and that volatility is quite low. And guess what has happened the last 40 years? We are at generational lows in volatility across asset classes. Asset trending, I think this is something most people don't realize, that actually assets, equity, for example, used to trend higher and lower. You can measure that through something called autocorrelation. All that means is that if today was down, it is likely that tomorrow will be up, and vice versa.
By the dip.
By the dip, that's right. So the assets for the greater part of a lifetime were autocorrelated in the sense that higher prices resulted in higher prices and lower prices resulted in lower prices. That autocorrelation peaked right when Nixon delinked the dollar versus the gold, or the US dollar versus gold. And we have underwent a multi-decade decrease in autocorrelations. And now we're at really peak mean reversion in markets. So a lot of strategies make the assumption that mean reversion is implicit to asset price behavior. That's definitely not always the case. So to that point, one of the strategies we actually tested was buy the dip. How would buy the dip perform going back 90 years? This is very interesting. Buying the dip, you don't think of it as a short volatility strategy, but it is short gamma, or it's short that autocorrelation effect. Well, buy the dip has performed incredibly well over the last 10 years, and really over the last 20 years as central banks have been very reactive to market stress.
That's an understatement.
Right? Well, it's very interesting. If you go back and you test buy the dip over 90 years, that strategy goes bankrupt 3 times.
Bankrupt's a big word.
I mean, flat out loses all of its money 3 times over a 90-year history. It is only really in the last 10 years where it's compounded at about 10% a year where we've seen that outperformance.
I think that might, let's see, is that the quantitative easing era?
I think
It is.
it's not a
think so.
coincidence. Yes, not a coincidence at all.
So you tweeted out something a few days ago about long-term deflationary trends.
Yeah.
It feels like we keep going there. What in your mind could possibly ignite inflation? Because it's the one thing that nobody is expecting. We're all expecting wash, rinse, repeat, more deflation next time there's a disruption of any kind. And again, every central bank comes riding into the rescue with more stimulus.
More stimulus. So looking back at, there have been other cycles across history that are like an Ouroboros eating its own tail. If we take this beyond just short volatility, we can think of it as part of the entire debt deflation cycle. So this idea that you start out with something good, you start out with real economic growth, technology, and demographics, and that leads to growth. And fantastic, you're growing, the economy's growing, it's fundamental growth. At a certain point in time, the fundamentals get stretched, and we become reliant on fiat devaluation and debt expansion.
So think of the baby boomer generation generating genuine economic growth, and then they're starting to move to spending less. And how do you fill that gap?
Exactly. So to this point, we start out in this framework. It's in the period of 1984 to 2007, one of the most incredible periods of asset price growth and asset appreciation growth in not just American history, in history period. 90% of the returns of a 60-40 stock bond portfolio came from the 22 years between 84 and 2007. Just 22 years drove 90% of the gains of that portfolio over 90 years.
I probably couldn't count on one hand the number of investors who've been around since before 1984.
Exactly. The average investment advisor is 52 years old. They were kindergartner during the stagflationary period of the 1970s. So you have all these baby boomers, 76 million baby boomers, largest generation in American history. They're teenagers right into the devaluation of gold in the 1971. That is driving a tremendous amount of inflation at that point in time. Interest rates go up to 19%, and then these baby boomers, 76 million of them, enter the workforce right in the early 80s. And they start making money. They start making money, and they start spending. They start investing. So you have baby boomers coming on in. Then you have a trend towards globalization. So we're able to export our inflation overseas. You have a technology boom as well. And then interest rates begin dropping.
Oh, yes.
So, and
May he rest in peace, Paul Volcker.
Exactly. And as if that's not enough, taxes start coming down. So you have this once in a generation, once in several hundred years, economic boom, asset price boom that occurs, driven as baby boomers come into the workforce, begin savings, enter their prime earning years. But now those boomers are going to be retiring. They're going to be drawing $28 trillion out of markets instead of putting that into markets. This obviously presents a tremendous deflationary force. So I like to think about this as a snake. If we take the snake metaphor and we pull it out, it's not just short volatility. It is almost like a snake devouring its own tail as part of a business cycle. The snake is eating prey naturally, compressing inwards through secular growth, and that's healthy. But towards the end of the secular growth cycle, that snake relies on financial engineering, excess leverage, and begins eating its own tail. And that is where we're at, I would say, in the cycle right now. And you've written beautifully on this about some of the debt problems out there. You know, currently we're at 48% debt to GDP, highest corporate debt to GDP, highest level in American history.
You tack on, you aggregate non-financial, we're at 74%.
74%.
So, I mean, unheard of numbers.
And what are we doing with this? What are corporations doing with this debt? They're issuing debt to buy back their own shares at $1 trillion a year. And then institutions are funneling that in order to, they need to find ways to generate yield absent any fundamental growth. So we have a year like last year where there's no actual earnings growth.
Earnings, yeah.
But it's all multiple expansion driven by share buybacks and speculation. So we're at this end of the cycle where the snake is devouring its own tail. Now this can go on for a long time.
Clearly.
Well, what breaks that cycle? And this comes to the image in the paper of the allegory of the hawk and the serpent. And I was thinking about this, and outside our offices here, we have a peregrine falcon that flies around and will...
Yes, I saw that on Twitter. You need to tweet more often, by the way. Can we get a Real Vision thumbs up on that? Thank you.
I do a lot of doing a lot of research and
Yes, of course.
work, but I'll try a little bit more. But I'm still getting used to it, by the way.
Yes.
Yeah, the whole retweet thing threw me
gets
off.
tricky.
It gets tricky a little bit. But that hawk, I noticed the idea of a hawk, and there's an old symbol of a hawk fighting a serpent. And this symbol has deep roots. It's actually on the Great Seal of the U.S. It's on the coat of arms of Mexico. It has important ramifications across different traditions ranging from Aztec to Egyptian to Indian. But this idea, to me, what it represented is the serpent represents the secular growth cycle that becomes corrupted at a certain point in time where the serpent begins devouring its own tail. It is unable to generate growth naturally and has to self-cannibalize. And the hawk comes down and represents the disruption of that cycle. But the hawk has two wings, which also work with the probability distribution. On the left wing...
Wow, that's deep. Okay.
So the metaphor goes deeper. On the left wing, we have debt deflation. This is what Japan has experienced. That's one way you get out of this decaying growth cycle.
Slowly.
Slowly, painfully. That's what the US experienced in the 30s. But on the other end of it, you have fiat devaluation and reflation. That is where you simply devalue your currency, and that could be helicopter money, devaluation of currency, money printing. That is another way that you get out of that crisis. This is as old as money itself, and one wing can occur before the other. You can have a deflationary crisis before you have a reflationary crisis. So to get back to your original question, what could I see causing inflation? You have a scenario today where the two largest blocks of the US population are baby boomers, right? At about 22% of the population right now. They're rich. They have a lot of money. They've lived through one of the most incredible periods of asset price growth in history. And they want to protect that money. So they are going to support policies, or are incentivized, I should say. They don't need to, but they're incentivized to support policies that protect their retirement and their entitlement benefits. Now you have millennials, which are now the largest generation at 26% of the population, and Gen Z following, likely to be the first generation in American history to be poorer than their parents.
It's remarkable.
Remarkable, yeah. Lower household creation rates. Average millennial has substantial student debt.
Low savings.
No savings, that's right. So the incentive of the average millennial, they're incentivized in essence to pursue policies that represent redistribution of wealth and seek to tax, redistribute, and cause inflation.
Right.
So I think the time to look, and maybe what could cause inflation, is the political sea change towards...
At some point, I mean, we're at 23 trillion now, but to your point, at some point you're going to hit a level of debt if truly all of these social spending initiatives are financed by printing money, theoretically. At some point you will hit a limit. I agree with you. You talk about passive investing. It's kind of a hot button. 90% of flows go into passive strategies. Even pensions are in passive strategies. Talk about the perfect liquidity of passive investing.
The concept of passive, and now we're at a point where passive investments have eclipsed active for the first time in history. And my friend Mike Green, who's a friend of Real Vision, has done a lot of fantastic research on this.
Yes, he has.
And I've done some work, in essence, trying to replicate his assumptions using some toy models, and what was able to do that. But his theory at the end of the day is that at a certain point, if the market is dominated by passive actors, it not only amplifies volatility, which I completely agree with. If there is no other incremental seller against a buyer or buyer against a seller, each incremental a buy or sell will result in massive movement in the underlying. So
It's an amplifier.
it's an amplifier. Because if you look at active investors are a volatility dampener. Value investors will come into the market and they will buy when there is a big collapse in asset prices. So they will, in essence, put a floor underneath asset prices, and they'll sell when asset prices go too high. Well, you remove all the active investors, and that will amplify volatility. The other factor that comes into play a lot of the time is this idea that it actually reduces the alpha available to active participants.
Clearly, we're watching one asset manager after another, one hedge fund after another go away.
Because in essence, like passive is in its own right a systematic strategy. It has elements of, it is a basic systematic strategy. So it goes back to this soul of investing. There are two different competing thought processes, I think, that are at war with one another. The one thought process is that assets should have a value, that there should be a value, and that market participants are fighting to determine what that value is. But there is, in theory, some intrinsic value to it.
Price discovery.
Price discovery. There's a second school, which I think is gaining strength right now, which is forget intrinsic value. All that matters, according to this school of thinking, is the price momentum of the asset.
You can burn your MBA. You don't need it anymore.
That's right. So aspects of factor investing follow this principle. Whether it's momentum, quality, whether it's FANG, whether it's cat ownership of company management, whatever the factor is, as long as people believe in the factor and keep buying and keep providing, and as long as there continues to be liquidity, that creates value. I'm clearly in camp number one. I clearly believe that there's intrinsic value. I believe.
Well, if you go back 100 years, there is.
There is. And I would like to quote Harley Baseman, who once had a fantastic quote. He always says this, that pigs can fly if shot out of a large enough cannon, but they always return to earth as bacon. He's so right on the money, with his usual wit. With a large enough amount of central bank stimulus and enough ability to create debt,
Right.
you can create this illusion as to momentum and these factors that. So I actually think passive investing is actually just a liquidity momentum trade.
I would agree with you. I mean, look, well, October 2018, it was not pretty. It acted as an amplifier, but on the downside. But we haven't seen a lot of that. You put venture capital and private equity into your 70% slice of the pie. Explain that.
Yeah.
Because I don't think that if you went down to Texas teachers, for example, I don't think that they would say that they would say it would be at the opposite end of the spectrum, and it would be a diversification strategy against publicly traded equities.
So one of the concepts on doing this paper is I wanted to find a asset allocation that is a solution. What asset allocation can work over 90 years that can protect you against the deflationary elements of the left wing of the hawk and the reflationary elements of the right wing of the hawk? That led me to a very big conclusion, and it ties into the question about private equity. Most people think that excess return, that you want to take two asset classes and that both have solid returns and bring them together, and that you'll get a better result from that. That they prioritize the search for yield and prioritize excess return. And what I've found is that actually what people should prioritize is secular diversification. And what that means is that you should look to asset classes that can perform on the left or the right tail and boldly size them in your portfolio. That means boldly sizing counter-trend asset classes that perform when stocks and bonds don't.
So gold's not like the little 10% just in case?
That's right. Gold shouldn't be 1% or 2%. It should be 20%. Volatility should be 20%. Commodity trend should be 20%. And then stocks and bonds can make up the other remaining 20 and 20. Well, so private equity VC.
That stands the conventional wisdom on its head.
It does. Where many individuals have big problems trying to even allocate 3% of their portfolio to gold. Well, this gets back to the private equity VC question. Now, these are relatively new asset classes. It's tough to see their performance going back 100 years.
Right.
But Cambridge has fantastic data going back a good 20 years, 20, 30 years.
When I was at DLJ, we had a merchant bank. I mean, private equity was this cottage industry. Leon Black used to walk the halls. I mean, this was way before it was, they've got $4 trillion?
Yeah, it's massive.
I mean, massive.
Massive. Well, it becomes very clear from looking, you can just look at the return data from private equity and VCs to see that these asset classes are secular growth asset classes. They are correlated to the business cycle.
So they move in concert with publicly traded equities.
They move. You might get, you might get some excess return, but they are correlated to equities. They will lose money in the event that there's a wide-scale recession. That has, I should say they have historically lost money when that has occurred. I cringe when I hear leaders of very large, and I've heard this, leaders of very large pension systems, huge systems that have a lot of money, and they say that private equity and venture capital are diversifiers because they're lagged. This doesn't sort of work with the data.
And, I've been harping on this issue for years and years, and that's kind of when we went into the crisis, the baby boomers were still kind of an actuarial accounting assumption that you could kind of fudge with. Heading into the next downturn, they're going to be a cash flow issue for pensions. And when you factor in the illiquidity aspect of the alternatives, it just makes no sense.
No, it does not. And this is what we've seen. So I put up a post on Twitter, and I had 3 asset classes, and they were just sine wave graphs. The two asset A and asset B were highly correlated with one another, and they were slightly offset from one another. And asset C, the last asset, was a counter-trend asset. It was an asset that didn't make any money, but made money when all the other assets lost money.
Did it lose?
And
did it lose money?
Lost money, actually. Lost a little bit of money. It was kind of flat.
No, okay, critical words. Okay, continue.
And I posted to Twitter, I said, which of these would you combine? You can choose 2 assets to have the optimal portfolio. And of course, everyone says, well, we're going to choose the high returning asset and the counter trend asset because that's going to result in a dramatically better risk-adjusted return, as opposed to combining the 2 assets that have similar return profiles, which results in bigger gains but bigger losses. So Twitter, got that answer correct. 80% of people chose the trend and the counter trend asset. But what's interesting is that the big institutions around the world are doing the exact opposite.
Right.
They're taking equity exposure and then they're layering on more and more private equity exposure and more VC exposure and more high yield credit exposure and short volatility exposure and you name it, all because they have to reach the 7.25% return target. And at the end of the day, what you have is a portfolio that is tilted to secular growth, will perform in secular growth, but in the event that we have any regime change, any period of secular change, either on the left wing of the hawk with deflation or the right wing of the hawk with reflation, fiat devaluation, that portfolio will struggle and struggle terribly.
I wasn't surprised about most of what you wrote, but I was intrigued about how you view real estate as an asset class. It's got the highest return But
Yeah, so real estate's quite interesting as an asset class because I think most people don't really think of it as it is a levered secular growth asset. And your average person, I think, the average retiree, maybe not the institutions, but the average retiree, they would never go lever their stock portfolio 5 times, but you own a home, and that is a levered investment. That's not saying it's a bad investment. I'm not saying that, but most people don't look at it in that light. So in the same way that you structure, that one should structure trend and counter-trend assets to balance the hawk and the serpent, the idea of including real estate in one's thinking about one's personal portfolio, I think, is really important because oftentimes your job is driven by the economic growth cycle. Your home is driven by the economic growth cycle. And then you're levering that exposure to the economic growth cycle. And then you're also adding stock exposure onto that. So the average retiree with or the average kind of working individual with a mortgage has tremendous exposure to the secular growth cycle, levered in a.
and there's an extraordinary percentage of baby boomers with mortgages.
Yes, yeah.
And the rest of their portfolios in an index fund.
And very few people think about this. And the concept at the end of the day that somehow that will be insulated. I mean, stocks dropped 86% in the Great Depression, and real estate dropped to the same degree. Now, in prior cycles, when interest rates were at 19% and were able to be lowered, that created a dynamic where real estate performed somewhat like a bond. Every single time that rates went down, it increased the affordability for people to buy bigger homes. So that provided a cushion for real estate. Well, when rates are at the zero bound, several bad things begin to happen. First of all, your 60-40 portfolio can struggle in the sense that your bonds are not getting as much benefit.
Right.
But on top of that, your home price is not going to get as much benefit if rates can't be lowered.
At the margin.
At the margin, yeah. So I don't think people realize this. Rates where they are today, for us to get the same benefit on a bond portfolio, on a long duration bond portfolio, or the kind of same pickup in mortgages that we got after '08, the Fed would have to lower interest rates to negative 1.5%.
Ooh, don't say negative.
Right? To get the same benefit as people got based on where they lowered in 2008. I'm never going to say that's not feasible anymore because God knows what is feasible now. But I will say there are major social ramifications if they pursue a course like that.
Talk about one way that you would play volatility long, or if there is no one way, how do you said 20% long volatility. How do you do that?
Now, I take a very broad definition of what long volatility is.
Okay.
So let's start out with specifics. I actually went back and I tested using very defensible assumptions what different traditional explicit volatility strategies, how they would have performed over periods like the Great Depression, over like the 1970s. So for example, it's very popular to do covered calls. People will own stock and they'll sell calls against that. Large pensions will do that as well. Some people will do tail risk hedging. They'll buy put options, the various strategies. So I tested all of these strategies using very realistic assumptions going back to the 1920s. And those assumptions are laid out in very high detail in my paper. So one of the things I found, just to start out with, short volatility strategies, which in equity markets, currently there's upwards of about 200 billion of these strategies. Very popular, have performed extremely well since the 80s. These mean reversion short vol strategies, pretty much every single one of them showed complete annihilation of capital over 90 years. And I would say that based on very defensible assumptions that people should not only avoid these strategies, but also institutions that robotically and systematically apply them. And I believe there is a place for these strategies if they're used tactically. Using human discretion, say this asset has overpriced volatility, we're going to sell it as part of a trade. That's very different than what a lot of institutions are doing, which is they are constantly, systematically selling volatility for excess yield. And this includes even collateralized shortfall strategies. So most people have come back and said, well, what about something like a covered call strategy? Why would that show impairment of capital? And well, let's take a look at that. In the 1930s, the stock market dropped 80%. Now, if you were selling calls on the way down, you would have done a little bit better than someone who was just holding the stock.
Okay.
But then we had the deflationary left tail. Then you have the right tail, where they do the 1932 Banking Act, and they devalue, lower rates, devalue, and also devaluation versus gold. At that point, you had a 70% rally that occurred over a month and a half. So imagine that you're selling calls, earning a little bit of money, but you're holding that against stock, and you're losing all the way down. You lose 70% of your capital that way. And then you're selling calls into a 70% rally that occurs over a month and a half. And that wasn't the only rally. There was another rally that occurred in the 30s at over 80% over 4 months. And that was the Roosevelt devaluation versus gold.
Kind of hard to pivot in that short period of time.
That's right.
That's your point.
So these are political risks. You have deflation, and then you all of a sudden have a political shift that causes reflation, either through monetary or fiscal policy. And if one thinks they can predict that, they are wrong. There's just no way unless you're psychic. So with that same understanding how short vol performed, we can look at how long vol has performed. Long volatility, truly buying a straddle, buying puts and calls, would have been positive carry for decades. It would have made money and given you diversification over the 1930s all the way through the 40s, and also would have given you income in the 1970s. So to this point, one of the things we've advised is something we call active long vol, which is this idea that you forego the first movement in volatility. You're not looking to protect against exogenous risks, but when the market moves a little bit, you catch the momentum of volatility. And this is how we modeled it. It is an attempt to model systematically what active long volatility managers seek to do, which is provide portfolio insurance type of protection for lower cost to carry. But there's other long volatility strategies or counter trend strategies that are also really effective. Commodity trending is an example of a strategy that can be very effective. Commodity trend has not been very popular in recent years, but was particularly effective in the 1970s during that inflationary period, and was effective in the 1930s. And then finally, gold is a long volatility asset because it plays off of that fiat devaluation that occurs.
Of course.
So in this sense, by having parts of the portfolio, all of these asset classes are counter trend to equities and are uncorrelated to bonds. They show no correlation to equity and bonds. So to the same point, instead of chasing excess yield, what people need to be doing, particularly the large institutions, need to be positioning portfolios boldly in asset classes that are non-correlated to stocks and bonds, preparing for a period of secular change. Danielle, the numbers are amazing. The numbers are amazing. In my portfolio, that the replication portfolio going back 90 years that we show in the paper, you're able to achieve consistent performance above the 7.25% pension return target that is consistent through every generational cycle.
And that's how pensions should be invested for the long haul.
That's
Absolutely.
right.
We're going to go in the weeds, and then we're going to pull back out. Describe the evolution of cross-asset volatility. There used to be an order of things: FX, rates, equity. Has that been kind of destroyed in this era of all, you name it, VIX, MOVE, every gauge of volatility is at a record low?
That's right. Actually, equity vol, U.S. equity vol is actually relatively expensive comparative to like currency vol, for example, which is truly at all-time lows right now.
And that's a massive market that nobody ever talks about.
Well, I think one of the things is really, we talk about this short volatility trade, and I say, okay, it's close to $3 trillion in equity markets right now. the portfolio insurance was only 2% of U.S. equity markets, but in 1987, and that now these short volatility strategies of all of their styles are now closer to 10% of the market. That same trade is being replicated across multiple different asset classes.
Okay.
So we're seeing it replicated across multiple different asset classes. And of course you have which is something you've written quite brilliantly about, the reaction function of central banks. That's something I also talked about in a 2015 paper, where they are preemptively getting in front of.
Yes, this is, I've tried to communicate this, and I don't think that the market quite understands Jay Powell and how different he is, because he does understand credit volatility and he does understand what's at stake. So he's, unlike his three predecessors, he's actually trying to get out in front of what's happening. And that, it truly changes, it's not a reaction function right now. He's trying to proactively get out in front of this.
That's right. Preemptive, very similar to the way that the Bush administration sought to do preemptive strikes against terror. They are doing preemptive strikes on financial stress.
Right.
And I think we saw this. We have different models that look at thousands of different economic indicators, and but this last and economic and technical indicators, and a lot of the drivers of volatility were there in the fourth quarter of last year. We saw triple C yields begin exploding higher.
They still haven't come back in a lot.
They still haven't come back in.
No.
Yeah. We saw value begin to outperform momentum stocks.
Right.
Very interesting. We saw obviously a re-steepening of the yield curve after an inversion. That's a bearish signal. And then finally, the granddaddy of them all, we begin to see blowouts in the repo market. Of course, what that will do is inevitably, if that continues, you have a deleveraging of various hedge fund strategies that will impact asset markets. All of these things were big risk-off flags. However, I think the Fed obviously saw the same thing. And we have, I don't think people fathom this. They created $400 billion worth of liquidity to inject into the repo system, the largest expansion of the balance sheet since 2009.
Well, it was only 85 billion when it was QE3. So this is bigger.
Bigger.
It is bigger. And, I understand what Jay Powell's trying to do. I get it. Because he saw the credit volatility genie start to come out of her bottle in the fourth quarter of 2018, and it scared the dickens out of him. I mean, public pensions had their worst returns for that quarter. I mean, it's anarchy, and we'll get to that in just a minute.
Yeah.
So he understands the gravity of the situation, but it seems like the market has begun to play him. I mean, for every 100-point decline in the Dow, you have 1 basis point of rate cut immediately priced in. You follow it on your Bloomberg terminal. It's like clockwork. It's
the moral hazard of the problem.
And they're playing the Fed. The market players are playing the Fed, and I don't think people. This is the last thing that Jay Powell wanted.
Yeah, I mean, it absolutely has become this point where it appears that they're really between a rock and a hard place, because on one aspect, you are risking a complete melt-up in markets, which is already occurring. I mean, you look at the behavior of Tesla, for example, which it's kind of fun to try to watch the media justify it, but there's no justification. I think Tesla's vol term structure was dramatically steeper than the vol term structure of the VIX the other day. I mean, that.
Yeah, you tweeted that out. I was like, wow.
I mean, it's really.
There's so many different ways to look at it, but the mania is there. I mean, this is kind of like 1999 and 2007 walk into a bar. And hook up. Sorry, that probably wasn't very politically correct, but you've got the leverage and you've got the mania. I mean, you've got the two of them together.
I think that's. I could not have put it any better myself. I think you're right, and these are the two realities, and maybe they're trying to keep it together until the election.
Oh, I don't. Yeah, I don't. We don't have to go there, but I don't. I think Jay Powell is probably the least political Fed chair since Paul Volcker, but he also understands credit volatility. And he talked about it in October 2012, specifically. So,
and this ends up. I mean, it's interesting how this ends up impacting so many different things, because not only is there market expectations built on this, this results in the enhancement of that mean reversion effect that we talked about.
Right.
So one of the reasons I think one of the reasons why volatility worked for 70 years in all of its forms is because there was not mean reversion in markets. It had nothing to, it had less to do sometimes about the absolute spikes or the big down days or up days in markets, and more to do with the fact that markets would trend. Well, now, because people anticipate this reaction function, the mean reversion is so baked into markets, and then that incentivizes people to follow financial engineering strategies that profit from that mean reversionary expectation.
Yep.
And today there's a whole cottage industry in the vol world about gamma hedging. That's something that people talk a lot about now. It's a complicated issue, but effectively, when big institutions come out and short volatility, the hedging of those volatility shorts reinforces mean reversion to markets. So it's a little like a rubber band, the gamma hedging. And what I mean by that is that the rubber band stretches out, and you have a down day or an up day, and the hedging of all the short volatility products results in it coming back in. So people will buy the dip or do the opposite of what the market's doing. The dealers will do this to hedge. But if you get a big enough shock where that rubber band stretches too far, it can snap in either direction. It can snap on the left tail or the right tail in either direction. So in essence, it's not just the human beings that are now anticipating what the Fed, anticipating this behavior pattern from the Fed, but now you have machines that are being attenuated.
That's why it feels so systemic.
That's right.
Speaking of systemic, let's end this. Well, I could talk to you for hours, by the way. This is just fascinating. But let's wrap this up today with kind of where you conclude this wonderful paper. Richard Fisher and I met years ago when I was still inside the Fed. We had lunch. There were riots in the streets of Athens at the time, and I said, Richard, what do you make of this? You know, what can we draw from this? And I'd been writing about pensions for 20 years, and he said, Danielle, I fear that we'll have those riots in our streets one day. That the public pensioners and the people who are paying for the public pensioners, and if you're Joe Q with an IRA or a 401k and you lose most of the value of your equity holdings, and you're told that your property taxes or your income tax, state income taxes are going to have to go up to top off the pension that's just lost as much. Yeah. You talk about these things in public forums, and just individuals go at each other. Yeah. Talk about the societal implications of where we are today and what you see potentially happening, because you use the word systemic.
So the way that the average institutional entitlement portfolio is structured today, and this is not an opinion, I'm looking back across history, there is a recency bias. This is constructed for the last 40 years of unprecedented asset price growth. But if you look beyond that 40 years and look at how that portfolio will perform, at a best case, you're looking at kind of a 5% type of return. In a worst case, given where debt levels are and where leverage is, you're looking at something much, much worse. So if we just assume the best case, it makes 5% or 4% over the next 20 years, these entitlement programs.
Which is not enough.
And not enough, because they're targeting 7.25%. That will cause an expansion of the unfunded liabilities in just the state systems alone to about $3 trillion. If we end up getting a lost decade, that could go as high as $10 trillion. That $3 trillion number, that is the cost of 4 bank bailouts. It is the entire tax revenues of the U.S. government over the next year. And that is kind of your base case. These entitlement programs, which right now, based on the 7.25% assumption, will go from 70% funded to under 50% funded. And a third of them will be under 30% funded. And this is not including corporate programs and other personal retirement programs. This issue of asset allocation is a issue of systemic risk. It is a issue of social stability. Because we will be at a point where these entitlement programs will go belly up and face insolvency unless we can think differently about the portfolio construction. I could see a lot of different things happening. I could see a day where the Fed prints money to buy pension obligation bonds.
Chris, if I can tell you something, during the crisis when I was inside the Fed, it was debated.
Wow.
I mean,
that's amazing.
The idea, if you take logic to the end game, the idea of the Fed buying municipal bonds is perfectly feasible.
That's right, and that will be a backdoor bailout of Wall Street if that happens. You could see a radical progressive kind of dynamic where we shift to seize capital and where there's causes massive inflation. There's numerous ways, but the question at the end of the day is the average portfolio is only attenuated to this last 40-year period of growth. It's not about being afraid. It's about being prepared.
Right.
So my parents, during the great financial crisis, they came out ahead because they had allocations to volatility and gold. And that saved them and allowed them to retire on time. I think the institutions, the large institutions and the average investors, if they can find ways to invest large portions in counter-trend assets, not only will they get a better overall return profile and more safe return profile, but this will be a way for these institutions to be able to prosper during a period of secular change,
right,
rather than suffer. So I think this is a major. It is more than a financial issue; it's a social issue.
Right.
That these defensive assets, they're not for a rainy day. They're for a rainy decade. The problem that we face is not a problem of financial management or economics. It's a problem, it's a social problem. It's an emotional problem. It takes a lot of social discipline and to think differently. Many of our leaders would rather fail conventionally with the herd
Right.
than succeed unconventionally.
They're not Genghis Khan.
That's right. Yeah, that's absolutely right.
It was great talking to you today. Thank you so much for
Thank
being
you.
with Real Vision.
I had a great time.